Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing RTX's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. RTX is a major US contractor. They're the world's largest producer of guided missiles. Let's get started with the model. This is a large cap company, 132 billion market cap. They're trading at $92 a share, and they have 1.4 billion shares outstanding. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Amazing free cash flow growth. 2020 1.6 billion, it nearly tripled to 4.6 billion, then steady after that. RTX is a pretty new company. It's from the merger of two other companies, Raytheon Technologies and United Technologies Corp. Those two companies merged in 2020 to make this company. Before the merger, UTC, United Technologies, spun off its non-aerospace subsidiaries. Those were Otis Elevator and Carrier Corp. Let's get back to the financials. Net income is the profit or loss on the income statement. It's revenue minus expenses. A big negative in 2020, then a big positive in 2021, 4.1 billion. It grew to 5.3 billion in 2022. It is down in the trailing 12 months to 3.4 billion. They must have had lots of write-downs, like goodwill impairments. Revenue is a sales for the company, and that goes up from 57 billion to 67 billion. It had a really nice jump from 2020 to 2021, up 14%, but then not too much growth after that. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 168 billion. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $145 billion. We divide that by their 1.4 billion shares. Our calculated stock price is 101. They're trading at 92, so they're trading at a 9% discount. It's a buy according to the model. My future free cash flow growth is based off of analyst estimates, and the analysts get their information from the company. So if the company grows as expected, they should hit 10 billion of free cash flow by 2026. There are 68 companies in the same industry as RTX, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, 2.5 billion. CapEx is the investments in property, plant, and equipment. And almost all companies in this industry have to spend a good amount in CapEx, like Boeing and Lockheed Martin, because they do so much manufacturing. When you buy a warehouse to manufacture a product, you have to capitalize the cost of that warehouse. Capitalize means carry on the balance sheet and then depreciate over several years onto the income statement. A pretty good debt to equity ratio, 0.5. For every dollar of equity, they have 50 cents of debt. Boeing is NA because they have negative equity. That means their liabilities are higher than their assets. The main reason they have negative equity is because they buy back so much stock. Lockheed Martin is 2.6, so they're really leveraged. For every dollar of equity, they have $2.60 of debt. Some really nice dividends in this industry. RTX 2.5%, Lockheed 2.9%, they're the highest. RTX generates lots of free cash flow, second to Lockheed. RTX is the largest company in this industry in terms of market cap, a little ahead of Boeing, 26 billion ahead of Lockheed. They have a great price to book, almost the best in this industry, 1.9. So this means investors are paying $1.90 for $1 book value. Their PE is a little on the high side. Look at LMT, 15. They're the best in this industry. They have a great price to free cash flow, 28.5, better than the median average. Huntington Ingalls is number 1 at 15.5. Huntington is the largest military shipbuilding company. They do a lot of business with the US government. A lot of companies on this list do a lot of business with the US government, especially RTX. Their price to sales is 2.0, a little worse than the median, a lot better than the average. This means their market cap is double their revenue. If it was exactly 2.0, it would be exactly double, but it's not exactly 2.0. It's rounded to 2.0. And they're not really growing much. Their 5-year annual revenue growth rate is 1%. Look at Axon Enterprise, 30%. They develop weapons for the military, police force, and civilians. They used to be known as a taser company because that was their main product, the taser. But they've expanded. Now they sell dash cams, body-worn cameras. A lot of the police force have that. Let's take a look at their most recent 10Q. We'll start with their income statement. This column is a 3 months ending 9/30/2023. This column is a 3 months ending 9/30/2022. Then you have the trailing 9 months for 2023, the trailing 9 months for 2022. Their revenue is down. It was $17 billion last year. Now it's $13.5 billion. This is for the quarter. Product sales, $8.6 billion. That's down a lot, down about 30%. Service sales is up. It's $4.8 billion. A big reason their sales are down this quarter is because they had to take a loss of around $5 billion. This is for their powder metal matter fiasco. I'll show you on a revenue breakdown. It'll be clearer. Here's a breakdown of their revenue, the $13.4 billion. Most of it is in the US, $11.2 billion, $3.5 billion in Europe, $800 million in the Middle East and North Africa, $958 million in other regions. And you see this negative $5.4 billion in powder metal matter. There were some defects in the powder metal matter on their Pratt & Whitney turbofan engines. And this issue could cause cracks in the product. So they took a really big hit this quarter. That's why their revenue is down. Of the $13.5 billion of revenue, $6.1 billion is in Collins Aerospace, only $900 million in Pratt & Whitney. It should have been over $6 billion, and Raytheon, $6.4 billion. Of the $13.5 billion of revenue, $7.7 billion is sales to the US government. So that's a bulk of their sales. Foreign military sales through the US government, $1.3 billion. Direct foreign sales, $1 billion. Commercial aerospace and other commercial sales, $3.4 billion. Selling to the government is the best because the government has really deep pockets, especially when it comes to defense. They spend a ton of money. Let's go back to their income statement. Below revenue is the cost of revenue. The cost of products is $9.3 billion. The product sales is $8.6 billion. And the reason the cost is higher is because of that write-down of $5 billion. It should be a lot higher. It should be close to $14 billion of revenue. Service revenue is $4.8 billion. Cost of services is $3.5 billion. So the margins are okay in services. Obviously, this company spends a lot in R&D, $700 million. And SG&A, they have to pay their staff, $1.4 billion. As a percent of revenue, SG&A is up a lot. It's 10.4% of their revenue. Last year was 8%. And they mention it right here. SG&A increased $180 million. That's for the trailing 9 months. Mainly driven by a charge at our Pratt & Whitney segment related to customer insolvency in the second quarter of 2023. So they really took a hit on Pratt & Whitney. But that's a one-time thing. It shouldn't be reoccurring. Let's go back to the income statement. So they had an operating loss of $1.4 billion. Last year, they had a gain of $1.5 billion. A great time to buy a stock is when a company has an issue, like a big legal issue, and the stock goes down a lot. You can get it at a discount. I'm talking about really good companies when they have an issue like that, because those issues scare the market. But big companies go through lawsuits like I go through SOX. So they had a net loss of $1 billion. Last year, they had a net gain of $1.4 billion. Their shares outstanding are declining. It was $1.47 billion last year. Now it's $1.44 billion this year. Let's look at their balance sheet. Current assets, $46 billion. Current liabilities, $45 billion. So their current ratio is above 1. They have $5.5 billion of cash on their balance sheet. Accounts receivable is $10 billion. This is how much money other companies owe them when those companies buy on credit. Contract assets, $12.7 billion. These are contracts with other companies, like a contract with the US government. They have $12 billion of inventory, and they give a breakdown of the inventory, $3.9 billion of raw materials, $4.3 billion of work in process, and $3.9 billion of finished goods. Manufacturing companies break up their inventory into these 3 steps. They have fixed assets of $31 billion, $15 billion of depreciation on those fixed assets, so the book value is $15 billion. Their biggest asset is goodwill, $54 billion. Goodwill is the premium you pay when you acquire another company. $33 billion of the goodwill is from Collins Aerospace, $1.6 billion from Pratt & Whitney, and $19 billion from Raytheon. Then they have intangible assets of $36 billion. Intangible assets are things like trademarks or patents, so they're really heavy in the intangible assets. Goodwill is also intangible. About $90 billion of their assets are in these 2 categories, goodwill and intangibles. Their total assets, $162 billion. Total liabilities, $91 billion. Their biggest liability is long-term debt, $33 billion. Here's the $33 billion, and they give a breakdown. You can see it's a long list. It goes all the way up to this page. $400 million of that debt is due in 2023 at 3.7% interest. So it's due in the last quarter of 2023. And you can see the interest rate and when the debt is due. And we'll go to the next page, and you can see the interest rate, 7% due in 2028, $185 million. Some of the debt is due in the decade 2040s, some is due in 2050s, and the interest rate varies. Usually it's around 4 or 5%, but sometimes it's lower, 1-2%. When you take their assets minus their liabilities, you get their equity. Equity of $71.2 billion. They raised $38 billion from selling their business, selling stock. They bought back $18 billion of their own stock. That's called treasury stock. It's a contra equity account. It brings down your equity balance. And they profited $52 billion from running their business. Retained earnings is a sum of all their prior net incomes minus the sum of the dividends they paid out. Retained earnings are $51.5 billion. That's on the balance sheet. Remember on the income statement, they had a net loss of $984 million. I'll show you how the income statement and balance sheet are connected. So to calculate retained earnings, you take your beginning retained earnings, $52.5 billion, then you minus your net income. If it was a net profit, we would add our net income, like last year. So $52.5 billion minus $984 million gives us $51.5 billion. That's how we get our retained earnings for the current period. Let's take a look at the statement of cash flows. This is the trailing 9 months. The first section is operating cash flow. To calculate operating cash flow, you start with your net income of $1.9 billion. And this is how the statement of cash flows and income statement are connected. This $1.9 billion is right here on the income statement. This is the income statement, $1.9 billion. That's their net income for the first 9 months of 2023. Net income is the company's accounting profit or loss. It's not actual cash. The way to convert net income to cash is right here on the statement of cash flows. You add back the non-cash items on the income statement, you add back depreciation and amortization, $3.2 billion, and then you adjust for changes in working capital. They bought $3.4 billion on credit. That's a cash inflow because they're receiving products or services but not paying for it. So it's a positive in terms of cash. When they do pay for the products or services, it'll be a cash outflow in that accounting period. So even though they reported an accounting profit of $2 billion, they actually generated $3.2 billion of cash flow. That's why operating cash flow is the best metric to look at. It eliminates all the accounting headache. This is better than last year. Last year they had operating cash flow of $2.5 billion. Let's look at the investing section. They spent $1.6 billion in CapEx. CapEx is the investments in property, plant, and equipment. And it looks like they did some acquisitions because they added $536 million of intangibles. That's a cash outflow. So in their investing section, they had a cash outflow of $2 billion. In their financing section, they added $3 billion of debt. They added $500 million of commercial paper. It's a positive number, so I know they added it. If it was a negative number, that means they would have paid back the debt. That's a cash outflow, a negative. They paid $2.5 billion of dividends. They bought $2.5 billion of their own stock. So in their investing section, they had a cash outflow of $1.9 billion. So if you add up the $3.2 billion cash flow from operations minus the $2 billion cash flow from investing minus the $2 billion cash flow from financing, they had a cash outflow of $800 million in this accounting period. So the beginning cash in the accounting period was $6.3 billion. The ending cash, $5.5 billion. Let's look at the stock on Simply Wall Street. Its last price, 92, 132 billion market cap. Up 2% in the past week, down 5% in the past year. Let's see what they say about the company. RTX provides systems and services for the commercial, military, and government agencies worldwide. It has 4 segments: Collins Aerospace, Pratt & Whitney, Raytheon, and Space and Raytheon Missiles and Defense. The Collins Aerospace Systems segment offers aerospace and defense products and aftermarket service solutions for aircraft manufacturers and airlines, as well as regional business and general aviation, and also for defense and commercial space operations. This segment also designs, produces, and supports cabin interior, oxygen systems, food and beverage preparation, storage and galley systems, and bathroom and wastewater management systems, airborne intelligence, surveillance, and reconnaissance systems, test and training range systems, crew escape systems, and simulation and training solutions, information management services, and aftermarket services that include spare parts, overhaul and repair, engineering and technical support, training and fleet management solutions, and asset management services. The Pratt & Whitney segment supplies aircraft engines for commercial, military, business jet, and general aviation customers, and produces, sells, and services military and commercial auxiliary power units. The Raytheon Intelligence and Space segment develops and provides integrated space, communication, and sensor systems, and cyber and software solutions to intelligence, defense, federal, and commercial customers. The Raytheon Missiles and Defense segment provides end-to-end solutions for U.S. and foreign government customers designed to detect, track, and engage threats. They used to be known as Raytheon Technologies and changed its name to RTX in 2023. They were incorporated in 1934, 90 years ago, headquartered in Arlington, Virginia. Here's their share price since 1990. It had a pretty steady rise up through 2020, and that's where it peaked at 157. And it really fell off a cliff. It bottomed out at about $50. And it's up about 80% since that bottom, but it's taking a long time to rebound. It still seems like a pretty good value at this price. Simply Wall Street's valuation is right where they're trading at, $92. 24 analysts priced this stock at $97. Their revenue forecast for 2024 is $79 billion, 2025 $84 billion, 2026 $89 billion. This red line is their debt, and the blue line is their equity, and they were really close for many years. Now they're breaking apart. Their equity is a good amount higher than their debt, but they still have a lot of debt on their balance sheet. And this green line is their cash, so they do keep some cash on their balance sheet, a lot less than their debt. Here's their dividend yield since 2014. It was 2%. It peaked at 3.1% in 2020 because the stock price came down. And the forecast for 2026 is 3.1%. Greg Hayes, the CEO's annual salary is $1.7 million, total compensation $23 million. His tenure as CEO is 9.3 years. Not much insider activity in the past year, one buy and one sell. 81% of the company is held by institutions and 19% by the general public. The large LA asset manager with over $2 trillion of assets under management owns 9% of the company. Vanguard owns 9% as well. Then State Street, BlackRock, Wellington, Dodge & Cox, JP Morgan. Geode 1.89%, UBS. The Norwegian bank Norges 1%. T. Rowe Price 0.88%. Bank of America, lots of big companies. Wells Fargo. Their employee count has gone down. It was over 200,000 in 2013. Now it's 180,000. And the ticker trades in lots of places. The New York Stock Exchange, Deutsche Börse, Bern, London Stock Exchange, Mexican Bolsa, Santiago, Wiener Bourse, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and the NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.